Hello, everyone. My name is Monica Harper. I'm the Executive Director of the AACFB, and I'm pleased to welcome you to today's webinar, Boost Business Growth with Working Capital. Please note that today's webinar is being recorded, so all participant lines will be muted during the broadcast. However, you can submit a question at any time during today's presentation using the Q&A box, and they will be answered by the end of the webinar. Please reserve the chat for communication between attendees so your questions are easily identified by the presenter in the Q&A box. If you have a question and would like to ask your question verbally, please click the raise your hand feature and you will be unmuted to speak. Our presenters today are Stephen Engel and Corey Krogan with Channel, your partner in funding, and we thank them for sharing their insights with our audience today. At this time, I would like to turn it over to them. It is all yours.
Welcome, everyone. I'm Steve Engel from Channel, and with me today is Corey Krogan. I'm Director of Partner Relationships here at Channel, and Corey is Senior Vice President of Sales at Channel. Today, we're going to talk to you a little bit about working capital, and just to preface, we're going to talk to you about working capital's agnostic to Channel and Channel's products. This is specifically just about working capital in general, the history of working capital, why small and medium businesses need working capital. We're going to talk to you about the right time, the right opportunity for these types of loans. We've all heard of some negative attributes about working capital or merchant cash advances. So we're going to talk to you a little bit about bad practices. We're going to talk to you a little bit about the structure of working capital, including rates. Because this is the AACFB, we're going to speak to a little bit about how it complements the equipment finance product. And then lastly, but certainly not least, a big portion of this is why should you be offering working capital?
All right, just to start out with a little bit of the history of the working capital product. A lot of you are probably familiar with daily payments or come to think of the product through a daily payment. And a lot of that's because that's how this product started. It was initially geared towards being a retail product and came from a spot where a woman needed to be able to have access to buy inventory for the year, but didn't necessarily have the cash flow to get ready for the Thanksgiving, Christmas time of year for selling kind of children's clothing. So they came up with a way that they could essentially sell their future credit card receivables. And that's really where the program started. And it was really through bricks and mortar type businesses. So a lot of retail, QSR type restaurants, maybe some dentist and medical in there, but auto repair, those types of things where you have consumers coming into a business and charging their credit cards every day. And really the product was a great product at the time, is that basically it was a short-term payback, but their payment was based on a percentage of their credit card receivables. So the payment always fluctuated based on the revenue that was coming into the business. So if during the middle of the week, things were a little bit slow and the receivables for credit cards were a little bit lower, well, their payment would also reflect that as well. And if on the weekend, sales increased, well, their payment would increase, but just to the tune of how their revenues increased over that weekend period of time. But as this program slowly developed, as we all know, there's tons of B2B type businesses that need access to cash, that have great cash flows, and it slowly started to evolve to allow different construction, manufacturing type companies that are more focused on B2B type businesses. Now, those businesses obviously differ quite a bit from your retail business, as they don't have nearly as many bank deposits that are coming in every single month, even though they might have great deposits coming in, great bank balances. They just don't have the number of deposits coming in. So that's where probably over the last 5 to 8 years, the program slowly evolved more towards having a weekly payment so that it could align still with the cash flow on the business and the number of deposits that the customer is receiving, because they may only receive 10, 15 deposits a month versus 100, 200, 500 different deposits coming in every single month. So that's really where the industry has evolved in today, as more as business loans, where you do have a fixed term, a fixed payment, and a fixed amount of money that you're getting up front. And virtually in the working capital space now, a lot of what you see will be on weekly payments. And there's a number of companies out there now that are offering more monthly payments as they've gotten more comfortable with cash flow, where bank balances need to be at, stronger credit. So adopting into more of a traditional market, still that short-term nature of the financing, but less payment frequency. And that's really how things have evolved with this product over the last 25 years, because really when this product initiated, it was around 2000, 2001, and probably started gaining more mainstream steam in 2009, 2010, and has slowly evolved there to now where you see on deck and Bora and a number of different companies out in this space that are advertising all over Sirius Radio or on TV commercials and become mainstream for consumers to use. And a portion of why this has become more of kind of a mainstream product is businesses need access to cash. So this graph you see here on the right is a SageWorks study, which is a financial analysis and software group. So what this study has shown is they went out to small banks throughout the country and said, hey, when a small to mid-sized business is applying for capital, what is it that they're looking for? And so here's a breakdown of the different things that they were looking to access. You can see their equipment financing is about 19%. And then what we would say is the working capital opportunity is just obviously other working capital and being able to cover and bridge receivables that they come in and being able to secure that cash flow. Now, equipment's still a pretty big chunk of there, but if you think about equipment financing, depending on the business type or the size of the business, they only may need one or two assets that last them 5 to 8 years at a time. So their buying cycle is a lot less frequent. We're true believers that small to mid-sized businesses have opportunities that are coming across their desk on a daily and weekly basis. And to take advantage of those opportunities, often they need access to cash. And that's where the working capital product has come in really well, is that it's really an opportunity-based financing that we're not looking to finance long-term opportunities. It could be construction companies looking to get access of capital to for a project, or inventory that's going to turn over every 3 to 6 months, that you're having a return on that type of investment there, and being able to get quick access to that cash, which the working capital product does is that there's other availabilities to working capital or maybe cash out there, but going through a traditional lens, it's going to maybe take a little bit longer period of time, where in the working capital financing, oftentimes you can have approvals and funding done within 24 to 48 hours at significantly less information than what you would need to go through on a bank approval. So I think just something as you're talking to customers, keeping in mind that offering working capital may give your sales reps additional activity to be having with your customers. That yes, you can still focus on offering equipment financing, but as you're still trying to continue to retain those customers down the line, that you have other product offerings that could still help and assist their business in moving forward and growing.
So on the last pie chart, Corey alluded to 56% of small businesses or small and medium-sized businesses that are applying for financing are looking for working capital. And so it begs the question, why do they need working capital? Why not go to a bank? Well, a lot of the small businesses, they have limited access to banks. They don't have time to stand around and compile 3 years of audited financial statement, let alone the financials might not meet the structured banknote requirements. A lot of times people are walking into banks nowadays and the bank goes, hey, go ahead. But if you don't have deposits with us, then we can't help you. And then it kind of begs the question, well, if you don't have $100,000 in our bank account, then sure, we can lend you money and we'll just lend the money you're depositing with us right back to you, right? It just doesn't make sense for the small businesses. And then the opportunity that they have on their desk, they might not have 60 to 90 days for that bank approval to come through. And that opportunity might be gone by the time that bank approval comes through. So it kind of leads into what we call right time, right opportunity, and then making it convenient for borrowers. Right time meaning you might not need working capital every single day, every single opportunity, but when the right time and the right opportunity comes across that small business's desk, do they have access to funds? How easy is it for them to access to cash, right? You got to remember small businesses, for the most part, they're not sitting behind a desk every day, running through financials, running numbers, trying to figure out their cash flow. Most small and medium-sized businesses, they're owner operators. They're out there, they're in the trenches, they're driving forklifts, they're in their excavators, if they're in the restaurants, they might be flipping burgers, they're managing, they're very busy people. They don't have time to sit around and always figure out their financials. When they do, it's usually early in the morning, it's late nights, it's on the weekends. That's just how a lot of small and medium-sized businesses operate. So working capital is extremely convenient for them because they can access cash super fast and it's super convenient for them. So right time, right opportunity is a big reason why working capital aligns with their business, and happens to be very convenient for them.
All right. Oftentimes you hear on the working capital product on kind of terms and the short-term nature of this type of financing. And really a big piece of that is it truly is revenue-based financing. Generally speaking, you're getting an application and bank statements for any working capital provider that's out there. And depending on what type of industry is and just the general macroeconomics, their business could very well change every 12, 18, 24 months. And so when you're basing a transaction specifically on the revenue type of that business, you're putting yourself at extreme higher risk of that. I was basing the revenues and where that business was at 24 months ago or 36 months ago, and that could be completely different today. And that could be for the better or potentially could be for the worse and put you at a little bit more of a risk there as well. Also with the working capital, due to getting the ease of that capital, it is oftentimes unsecured and unrestricted capital as well. So there's not necessarily going to be a lien filed on any assets or on a home or a blanket lien on the business that way as well. So as you continue to extend those terms out farther without having that security, without continuing to understand what the revenues of that business are, you're going to continue to have yourself at risk of defaults there as well. And again, we are offering unrestricted cash. If a business owner is getting cash and has an opportunity today, likely that money is going to be spent in the initial 2 weeks or certainly within the first month of that. And payment fatigue becomes very real in this, if I spent money 24, 36 months ago, or even sometimes even 18 months ago, and I already got my return in 6 months or 12 months, and I'm still continuing to have to pay on something that's not actively affecting or growing my business, that payment fatigue becomes real for the customers and payment stop, those types of things, because they're still not realizing the benefits of that working capital. Where on the equipment deal, if you're buying that asset, it is providing revenue for you throughout the useful life of that asset and through that 5-year note that's going to be on the equipment deal. Same thing kind of works here on the working capital, is that we're trying to align our repayment periods back closely with when the customer is going to be seeing the return of that working capital. And we have, there's opportunities to extend terms that have early payoffs and different things like that. But again, unsecured, unrestricted, trying to avoid payment fatigue and also make sure that our payments are still in line with what the revenues of that business are today. And as you can see, there's kind of an example there, about $50,000 note for a contractor to help with project expenses. Oftentimes they'll have that repayment within 12 months or maybe even a little bit shorter than that, so that you can align that as that customer is getting the returns for that project, they're going to be able to pay you back for taking that financing, and you're truly aligning with the cash flow and then allowing for additional opportunities for them to take advantage of in the future as well. And so you often hear about kind of the cost of the financing or APR. A lot of that really comes from the short-term nature of the financing. Now, whether you're underwriting a working capital deal or an equipment finance deal, the expenses that you're going to accrue are very similar, right? The credit reports you need to pull, the people that you need to pay, keeping the lights on, paying the lease or the rent or the building that you're in, all those types of things, all those expenses are still there. And then also you think about it, because of it's unrestricted, unsecured, limited information that you need up front to get an approval, there's going to be a little bit higher risk tolerance and there's going to be a little bit higher default rate that you'll see on working capital than what you're going to see at a traditional equipment finance portfolio. So what we're trying to do there, that again, those are still sunken costs that are going to be there that would also apply to the equipment financing. But as we're trying to align the financing with the payback of the note, we still have to accrue those costs. So as you can see here, 15, 12, 9-month terms, very typical within the working capital space. And I would say the factor rates are generally, kind of average to the industry. If not, you could find better rates out there. You could see that the payback becomes a little bit less in a lot of those scenarios than what you would compare if you had an equipment finance deal over a 60-month term at a 12.5% sell rate, which would be a pretty average sell rate that you would see out in an equipment finance deal for a pretty strong customer base. And I think the terms here would align with that type of customer that you see in the equipment finance example above there. So yes, the APRs may seem high or expensive, but you're cramming that interest into a much shorter term. But when you look at it, oftentimes on a working capital deal, what's coming out of pocket could be less than what you would pay over a traditional equipment finance deal at a 5-year term. Now, obviously, if you're getting 5, 6, 7%, things might be a little bit different there, but kind of looking at a traditional equipment finance market there.
So this is my 7th year working in the working capital and equipment finance industry, and Corey's been over double that. But if you look back, there's been hundreds of businesses that have come and go and come and go, and there's only a few that have lasted throughout that whole time. And it's no coincidence that they have very similar business practices, and they think maybe not all business practices, but they think a little bit about the world the same way, in the sense that they would require to be what we call first position only, where they would not stack other working capital loans on top of other working capital loans. And what I mean by stacking is when someone takes out a working capital note, often borrowers don't know when to say no. And there are brokers out there and there are other lenders out there that they would take a loan out and they would take another and another and another, and they do whatever it takes. And they're more transactionally driven companies than they are relationship driven companies, which is very different from the equipment finance world. They'll do whatever it takes to make that next dollar. And so what they do is they take a loan out and they take another loan. And at some point, the interest just becomes too much for those borrowers. And the result is, you can see where it's going. It becomes too much for those borrowers to handle. And then they have to consolidate that debt. If that borrower can survive that, it's just a horrible practice. So the better lenders, or the folks who have been around and have survived long enough and know what they're doing, they would require to be first position only, meaning when they provide a working capital loan, they can't have any outstanding loans with any other companies. And when they provide that loan, right in their documents or however they want to do it, they would say, hey, if you take this loan with us, this is the only short term. And when I say short term, I would say under 24 months, but this is the only short term loans that you can take out. Anything past that, we would consider your company over leveraged on short-term notes. Probably wouldn't consider a traditional bank note in that realm, but there's a reason they do that. All the adjudication process is how much can this business handle without being disruptive to their business. Excessive rates, we've all seen it. If you've been around in this industry long enough, you start to see some of these crazy rates, and the rates are high enough as they are when you start to see some of these factor rates. But the way you determine whether a rate is too high for a borrower, whether it be 30 cents on the dollar or 20 cents on the dollar or 40 cents on the dollar or beyond that, it kind of comes down to how you sell it. Because if the return on investment for that borrower exceeds the rate of the deal, at least you know that's a viable option for their business. If they're making money on the deal, at least you know that business is floating. Now, at some point, if your interest is doubling what that loan costs, well, that there might be a call that has to be made for the sake of the business. But if it costs 30 cents on the dollar over 12 months, that might seem expensive. But if that borrower is doubling their money, Well, what's 30 cents on the dollar if that's their only means of making that cash or that return, right? It becomes a pretty easy decision if that's the only way they can take advantage of that opportunity. And that's where some of the better companies, that's how they sell, that's how they think about the world. And then lack of transparency, right? This is just basic sales. This is not necessarily unique to working capital or equipment finance or anything else, but it's you're getting $10,000 and you're going to pay back 12,500. It's helping people understand what they're getting into, no bait and switching. And you don't always see that out in the working capital industry. You see that a lot in the independent sales organization industry. And the result of that is, and you would hear it more in the merchant cash advance space, is a bad reputation, right? So remittances, a lot of times it comes up, I don't want a daily payment, I don't want a weekly payment. But due to the short-term nature of these loans, when you think about a monthly payment, that monthly payment, think about $1 million business, and maybe that $1 million business qualifies for $100,000. Well, that monthly payment becomes drastically high. Versus a weekly payment, let's say you were pulled 52 weekly payments as opposed to 12 monthly payments, a much smaller weekly payment tends to go unnoticed compared to 12 large monthly payments. On this graph that I have here, the blue line I took from an actual business is someone's bank balance. And on average, this was actually just below $1 million business. And they're holding about $12,000 to $13,000 at their bank anytime. And I think anybody would agree for a $900,000 business, 12 to 13 grand is somewhat normal for a small business. It's not a bad bank balance. But the purple line on this graph would represent what a monthly payment remittance would look like. And the green line on the graph would represent what a weekly payment remittance would look like. And you can see that most of the time that monthly remittance goes unnoticed. And yeah, if you pull on week 6, you're going to get an NSF. You're not going to have enough funds in the account. But what I worry about more, I could always pull my funds the next day, but I worry more about pulling, and then all of a sudden that business has to go make payroll the next day. Well, now I'm being abrasive to their business. And that defeats the whole purpose of these loans. These loans should be opportunity enablers, not disruptors to small businesses. It's all about reframing the way you think about these loans. They're opportunity financing. But now you look at the weekly remittances, and at any given point through the first 18 weeks of that loan, you're completely non-disruptive.
All right, on rates, again, we've kind of touched on this a little bit, and I think there's, it's certainly not inexpensive capital that these businesses are looking to obtain, but there's certainly a few reasons for that. So we've touched on kind of a few of these, but just to go a little bit more in depth on this is, again, the unrestricted unsecured funds of this business. So when a working capital source is going to fund, they'll just ACH the business the funding amount into the customer's bank account, and from there it's up to them to use that money within their business and invest it within their business however they see fit. There's not a detailed list of showing this is exactly what it's used for. It's up to the business owners at that point in time. And then oftentimes there's not going to be a blanket UCC filed, or again, any filings on any specific assets that are out there specifically to the working capital product. So within that alone, oftentimes you will be getting a personal guarantee, but again, no assets to help recruit some of those savings that maybe you lost on somebody that defaulted on you. So that you have to account for some of the losses that you're going to take just due to the nature of this product. Another reason for that, and maybe for some of the losses too, is the ease and convenience of getting this working capital. So generally speaking, you can get approvals within 2 to 4 hours, oftentimes maybe even less than that, off just an application and 3 months of bank statements. And there's companies that do 250,000, 500,000 off of that type of information, and just the 3 months of banks and what their revenues and bank balances are. So it really does become an abbreviated underwriting process to help further move those deals through and helping those customers get access to that capital as soon as possible. So with that limited information, you're not quite seeing the whole world or getting all of their financials to kind of understand that structure. So obviously going to lead to some additional costs there. And then again, being that it's revenue-based financing and not trying to get out of the scope of a customer's revenue cycle, that's going to increase that's going to shorten the terms, which is going to effectively increase what that total payback is going to be. So really, when you're kind of talking about rates and the working capital product, it becomes a return on investment type of pitch. You have to be taking this capital to move your business forward, to grow your business, to take advantage of the next opportunity. If you're not doing that and just putting it as a feel good at night money, you're just going to drain right through that with your repayment. So this is money and capital that you need to put actively into your business. And as you're talking to the customers, you need to understand that does that investment or does that opportunity, does that return outweigh the cost of what the total payment is on that financing? If there is, then there's a good business decision that could potentially be made for that customer. If it doesn't, then this financing product doesn't make sense for that particular opportunity for that customer. This product's not going to fit all needs for all people, but it does provide a lot of opportunity for small and mid-sized businesses to take advantage of opportunities that are within their business and do that effectively at a fast pace that they don't have to hold up for a quarter at a time in order to get access to that capital and take advantage of that opportunity. And then oftentimes working capital can be complementary to equipment financing as well, right? I think when people are going to purchase equipment, they're in an active buying cycle and oftentimes in a growing cycle within their business of adding on some maybe additional equipment or equipment maybe the business hasn't had before to take advantage of new opportunities or projects that come available. And oftentimes with that, you need more materials, more inventory, potentially more people to help assist with handling that equipment or driving the trucks or whatever it may be. So offering working capital at a time of equipment financing or maybe shortly after, there could be a lot of opportunity there because a business is in kind of a growth mind or in a buying mind at that point. And there's times where they're not necessarily thinking about, because I got this piece of equipment, that I'm going to need some additional capital, or I didn't think about what the total insurance cost was going to be for adding that additional driver. I could really use some cash as I was only expecting to have to pay salaries and those types of things. So we can help supplement some of that growth with some additional cash until that equipment starts making money for that business. And then I think with the why offer working capital, if this has become more and more popular, and as we've kind of talked about at the beginning, if you're not offering your customers working capital, there's plenty of people out there that are. There's a bunch of national ads that are targeting directly to the end user customers looking to get out of broker and partner relationships so they can attract that customer directly to them. They're getting hit on radio, TV, mailers, emails, all the things, and they're getting flooded with it. I'm sure some of you have even gotten some of the marketing material in the past. And within the equipment finance space, that working capital product has become more and more popular. There's a number of equipment finance companies that also offer working capital. And so if they get in contact with that customer for working capital, it now becomes part of their ecosystem to start offering equipment financing, even though you may have helped that customer in the past for equipment financing. So not necessarily something that has to be a hard sale, but it can be something that say, hey, this is an option I have for you as far as working capital goes. So you can continue to keep those customers within your ecosystem and continue also financing the equipment needs that your customers have in those relationships that you've worked hard to build over the years and keep them within your teams.
So that's all we got. Monica, do you want to take it from here on questions?
Yes. And just as a reminder, anyone has a question, please put that in the Q&A box and we will get that answered. Or if you would like to speak, you can raise your hand and I will unmute you and you can ask your question that way. There is a question in the chat, but it's more specific to channel. I don't know if this can be answered in a generic way.
We'll do our best.
Okay. As a broker with only 2 years old, I've encountered a challenge with requirements for brokers to have at least 5 years experience. Is there any way to waive this requirement? So I don't know if that's an industry-wide thing or if that's specific to channel.
I'd say let's have a conversation. Monica, can we follow up and pass out Corey and I's contact information after this?
Absolutely.
And I'm always happy to have a conversation. 0 to 100 years time in business. I'm happy to meet people, and if now's not the right time, maybe next year is, maybe next month is. I don't know. We're never quick to say just no, right? I want to meet everyone and learn about what they're doing.
Sure. And I think that is probably industry-wide. I think that a lot of funding sources would say the same thing, that if it might be a specific situation, it might be a specific deal, or there's a lot of nuance around some of these things that one of them you might say no to, and another you might say let's take a deeper look. So.
Yeah. I would say, yeah, a lot of nuances that go within that. I would say, generally speaking, a lot of funding sources do have certain requirements, and time in business is often one of those. I think equipment finance may have a little bit higher barrier to cross on that because the margins are much thinner on that. So maybe more protective on which partners they're working with. You may have a little bit more luck in some working capital funding sources to start gaining a reputation and working with some of those companies, as there may be a little bit less barrier. There probably is still some requirements, but maybe a little bit less barrier because there is going to be more margin that could be involved there, that again they could maybe take slightly not more risk is not what I mean, but go further down the spectrum as far as maybe experience or some of those other things that an equipment finance source would look for.
Yeah, and to whoever asked that, what I'll say, it hasn't always been like this. If you go back 3-4 years, everybody, or I wouldn't say everybody, but most people were signing up everybody as long as they got to understand their business. It's a product of the market and the environment that we're in. It's tough, but like everything, this too shall pass. So stick with it, right?
Right. This is another one, just as a reminder, everybody, we're trying to not be specific to channels programs when you're asking questions about working capital. But if an insurance agency asks about a line of credit that they can tap as needed and pay back quickly, would that work for a fast payment option?
So what I'll say is, for insurance, it is a little different, and I can't speak to how other lenders view it. At channel, insurance would be restricted for us, but where I have seen insurance be successful is you get these insurance agencies where a owner has franchises, and they don't just own one franchise insurance agency, they start to buy another and another and another, similar to like a Domino's franchise or a Subway franchise. And every time they buy one, there's a whole slew of costs that are associated with that next franchise. And sometimes it makes sense to do a 12-month note rather than a traditional bank note. So sometimes a working capital loan may make sense. For channel specific, that would be a restricted industry for us, just because we don't come across them enough, and we just steer clear and keep an arm's length there.
Do most of the working capitals have the similar restricted industries, or are they all different?
Yeah, in general, I'd say the big ones, you're not going to find a lot of folks doing arms dealers, marijuana, out of country stuff. There might be some folks that dip into Canada, like on deck and stuff like that. But in general, most people are going to have similar stuff, right? But you're not going to come across those opportunities a lot. They're going to be similar to what a bank might do. Nothing would surprise you.
Mhm. Okay. I don't see any other questions. So what I will do is I will put the people that ask specific questions, I'll put those in touch with you guys, and you guys can answer those specifically with whatever channel would answer those. And yeah, so I want to, oh, we have one hand up, so let me allow them to talk. All right, Sunny, you should be able to speak now.
Thank you. Hey, Stephen. Hey, Corey. Actually, I'm the one who asked the first question, but however, I have a different question. Thank you for giving a background on what are the controls and the things around the working capital. Would working capital also work for equipment dealership? I have somebody reached out to me a couple of days ago, and they wanted 250K because they have secured 5 trucks from auction, and they were like, I need a 250K. We have a lot of equipment, but this was a great deal. Would this product will work in that scenario, or?
So we actually get a lot of our partners, vendors that end up on our plate for working capital, whatever the scenario is. We try not to ever put working capital in place of equipment finance. That's never the intention of it. But occasionally there is a right time, right place, right opportunity, and they don't have time to go to the bank, and a working capital loan might make sense. And my guess for something like this is they need to move fast, and we would specifically layer in, and again, this is kind of more specific to channel, but most people would have some sort of a function in their loan that works like this, but they'd have some sort of a prepaid discount where if they paid that loan off early, they discount either the remaining interest or however they want to structure that substantially, where it made sense for that, in this case, the vendor, where it doesn't cost them the full amount of the loan. Not necessarily like a mortgage, but something that made sense for that vendor where it's not super expensive for them.
Got it. Yeah. Okay. By the way, I'm looking forward to having conversation once Monica shares the information. I'll set up something, probably short Zoom call or something.
Okay. Likewise, Sunny.
Thank you.
All right, perfect. Well, with that, we will conclude today's webinar. I want to thank everyone for participating, and this webinar will be posted in the members only section of the AACFB website if you'd like to go back and review it at any time in the future. Again, thank you for attending. Stephen and Corey, thank you for sharing your expertise with our members today. And everyone, have a great day.
Thank you.
Thank you, Monica. Thank you, everyone.